Hello, this is Kevin Shortle, National Instructor for NoteSchool. I have an interesting case study I want to show you today that shows how you can take a small amount of seed capital, take that capital, start to grow that capital while at the same time building up your own portfolio of notes. It's a really great technique for those who need to get started. They want to get started simply and they really want to start to build over time. So let's take a look at this transaction here. This is a typical working class neighborhood. This is the property that is the collateral for this note. Now, this was a performing note. And of course, performing note means that the people living in this property are making their payments and they're making them on time. In fact, they've been making their payments on this particular deal for a number of years. So, doing our quick due diligence on this property, you can run some simple numbers online just to get an idea of about what the property is worth. We know that Zillow and some of these other online websites aren't always 100% precise, right? But we just need to know if we're in the right ballpark here because these people are obviously taking care of the home. They're making payments on time. That's all great. But we never assume it's going to stay that way, so we always prepare for worst case scenario. That's what investors do, right? We hope for best case scenario, and we always prepare for worst case scenario. So this particular student went on and just did the basic internet research. And they saw that the estimate here for value was $32,000 from Zillow, and it would rent for almost $700 per month. And that's a little 1,400 square foot home with 4 bedrooms and 1 bath in Oklahoma. And by the way, this student does not live in Oklahoma. This student happens to live in North Carolina. So it doesn't matter where you live. You can do this business nationwide, and you want to go to where the best deals are. So additional research, this valuation, which is from Realtor Property Resources, they came in at a $52,000 valuation, but they even indicate on there that they don't have that much confidence in their number, meaning they didn't quite have enough data in the local marketplace to say, oh yeah, we've got a lot of comparable sales on this one. So 52 is a rather high as compared to the Zillow estimate. But the other thing is, look, this is a good working class neighborhood. It's got very, very low crime, as you can see. It's a very safe area. Homes are being well maintained, and it's just a good asset to have backing your note. Because remember, we buy these notes secured by collateral. And of course, the collateral is the property. So here's what this note looked like when our student bought this one. It had an unpaid balance, UPB, of $18,890. The note was written at 11.25%. There was only 72 payments remaining, and those payments are $373 per month. Now, first of all, if you're new to this, you might look at this 11.25% and go, who in the world would be paying 11.25%? Well, the reality is a lot of people. Remember back in the easy money days of the early 2000s, most people got adjustable rate mortgages. That's what they ended up receiving, and those things started adjusting up. And also seller financing. When you see seller finance notes, those are typically higher than market rent or market rates would be. But you know what the bottom line is? Their payment is affordable to them. And that's what most of these borrowers look at. They can afford the $373. In fact, if you remember, if we base our rent numbers on Zillow's $695 per month, these folks can't afford to move next door and rent. Right? Their mortgage payment of $373 is almost half of what the rent is in the area. So they're happy with that. In fact, they've been making payments for quite some time on this one. So when our student looked at this, he said, okay, what am I doing? I'm trading dollars for 72 payments of $373 a month. So his price on that was $16,679. So that's the little seed capital that he started with on this transaction. So he took his $16,679, invested it into this note, and then he starts to receive $373 per month. Now here's what he did. He collected 3 months of payments. In that 3-month period of time, he resold that note at par, meaning he resold the note at the unpaid balance. He did not sell it at a discount, in other words. He just sold it to somebody at the at the unpaid balance of this note. Because think about it. at par, that investor who's paying $18,278 is making over 11% annually on their money. That's what the note was written at. So our student paid the $16,679. In return, he collected $1,119 in 3 monthly payments, and then he sold that note for $18,278. So within 3 months, he took his seed capital there of $16,679 and grew it to $19,397. Okay, that's not going to change his world at this point in time. Remember, though, he's taking this and building this over time. So don't look at it and say, well, gee, he only made $3,000 in a period of a month. Well, first of all, the return on investment is pretty darn good, right? 90 days, if you make a $2,718 profit on a $16,679 investment, that is a 16% annualized return on investment there. So that's nothing to sneeze at, if you will. So he's done good there. But remember, the end goal is let's gradually grow this money as I go along. Now, so far, he has not started to build a portfolio of notes, though. All he has done is purchased a note, collected some payments, cashed out of it with a profit, and now he's going to take his seed money, which grew from $16,679 to $19,379, and he's going to reinvest that. And that's exactly what he did. In fact, he did that the same month. So the same month that he sold the note that he owned, he bought a new one. Now this one had an unpaid balance of $30,213. This one was written at 9% interest, and there were 140 payments left. Those monthly payments were $350 per month. So he took his investment capital. He paid $19,350 for that note. And you can see the property in the background was the collateral behind this. Now, once again, this was a performing note. So the people who lived in this home have been making timely payments. So once again, of course, he's going to run his due diligence, and you can see low crime. There is some red in there, and that's okay. There's going to be some of that in these price ranges, and that didn't scare him off, and it wouldn't have scared you off either. This one happened to be in Tennessee. Once again, this same student now bought a note in Oklahoma, sold that note. That same month, he bought this note on a property in Tennessee. He lives in North Carolina, right? You don't have to live by the collateral. So again, running the numbers, Zillow said 45,000. Realtors Property Resource with a 4-star confidence rating said 52,390. The rents are looking at $725 per month. So once again, the people in this home are incentivized to continue to make the payments on this note because properties in that area would rent for about $700 per month, and their payments are only $350 a month. Once again, their monthly mortgage payment is half of what the rent is in the area. They're not going anywhere. They're going to continue to make those payments. So here's what he did. In this case, he kept it a little bit longer. He kept it for 7 months. So he collected 7 monthly payments of $350. That's what their debt is on the note. That equals $2,450. Once again, he then turned around and sold some payments to another investor. But here's the difference. This time, he only sold the next 78 payments of $350 a month to another investor for $20,000. In other words, he didn't sell all of the remaining payments. He just sold a partial of the remaining payments. He only sold 78 payments in exchange for $20,000 now. That investor is happy because they're making a good, solid annualized return on their investment. And you know what? Our student's happy as well because, once again, he's been able to grow this seed capital that he started with. He now has $22,450 because he collected the payments, $2,450, and he collected $20,000 when he sold the 78 payments. But he also still owns the remaining 55 payments on the back end of the note. So when the investor who bought the 78 payments receives his 78th payment, all those payments will start coming back to our student. So now, not only has he increased his seed capital from 16,000 some odd dollars to $22,000, he also owns 55 payments on the back end of that note. So he's building a portfolio while he's growing his seed capital. What does he plan on doing next? Well, this is right from his email he sent me. I plan to take that $20,000 and roll it into another note and either sell the note at par or partial it out again, rinse and repeat. So you can see that you could take this and continue to grow that because he has plenty of inventory to look at. He'll just continue to buy these notes, keep them for a little bit, turn around and sell them, grow his seed capital, and then start partialing these notes out. So think about this 4, 5, 6 years down the road. How many of these note payments are going to start coming back to him? That's where it's going to get fun. And by the way, you can do this with your IRA money as well. If you have IRA money and other tax deferred accounts such as that or tax-free accounts, and those are self-directed, you can do this in your IRA or your children's IRA. And just think of where that's going to be over time if you just took this simple concept and kept rinsing and repeating, to use his words. Hope you enjoyed this. Look forward to sending you another great case study in the very near future.